Welcome to IBBA Insights, providing expert advice on buying or selling small businesses. IBBA Insights is presented by the International Business Brokers Association, the world's largest nonprofit organization for those helping others sell or buy businesses. Now, here's your host, Chris Diglio.
Hello, and welcome to the latest edition of IBBA Insights. I'm your host, Chris Diglio, and you can see this handsome gentleman right next to me, Mr. Steve Mariani, who's the owner of Diamond Financial Services. Steve is not only a personal friend, but a friend of the show, friend of the industry, friend of the IBBA, a big contributor to the IBBA, a great supporter. I believe he was given an award in the past for being the IBBA Advocate of the Year. I mean, he loves our industry, believes in it. And it's that time of year again where we're having SBA updates. And at any time we get an SBA update, my first phone call is my buddy Steve, and I say, hey, can you help us out? Would you mind coming on the podcast? Would you share some things that are going on? So as always, Steve has been gracious enough to say yes. So Steve, welcome back to IBBA Insights. Well, such a pleasure to have you again.
Chris, I can't thank you enough for not only today's session, which is going to be critically important, being we're going to discuss the updates and the advocacy going on right now, but for all the podcasts and for all the information you get out to the industry as well. I mean, you've been doing this for years and giving back. And just so you know that we appreciate everything that you do and contribute to the association as well. So let's not leave you off the list, and appreciate all your accomplishments.
So I appreciate that. See, we got the love fest out of the way now. So we'll go into the hard questions. But when we first started talking about this show, came up with a list of topics and questions I wanted to ask. But over the last number of weeks, there's been a lot of behind the scene things going on, a lot of some things you could talk about, some things maybe you can't talk about just yet. So I'm going to push the limits to see how much you can talk about. But I want to start with that. What is going on behind the scenes that we should know about within the SBA and the guidelines and changes?
Sure, and I appreciate that, Chris. And there again, I may catch flack for some of this later because there is some behind the scenes I'm involved with that I'm going to share with your listeners because I think it's critically important. I am an SBA Leadership Council member. I'm also in talking with the U.S. Senate Committee on Small Business and Entrepreneurship. The senator in charge of that has actually reached out to IBBA, and I'm on the short list. And we've been speaking on a regular basis. And what we're working on actually is a lot of the amendments that they want to submit to SBA in regard to the new rules. And we'll talk about a few of those as we go through the process. But one of the other things that I have been directly involved with is the $10 million increase that everybody's been talking about for the last year and a half. And I used to get a lot of pushback, and now that the administration is turned over, there's a lot more open to discussing this. But what I do want to bring to every one of your listeners' attention is, because you may have heard there's a $10 million on the table for manufacturing facilities throughout the country. Well, at first I took offense to that because I wanted for our world and our industry and our brokers. Here's what I found out, which I'm not supposed to disclose. That's really looked at as a pilot program. And that's going to be the first where they get to evaluate what it does to the budget, what it looks like in real life. And this is the first time I was made aware of this just this week after working on this for a few months. They said, really, we're looking to expand it after we understand the actual ramifications and how it affects us. So I think that's a positive note. For everyone who was looking down on just the manufacturing industry increase, no, that's going to help us all across the board. So I have made a big push to now promote that manufacturing increase to 10 million, which I understand to be passing within the next few weeks, is my inside information. So fingers crossed on that.
And just to put some context to that, or time frame, right now when we're recording this podcast, we're in the middle towards the endish of July of 2025. These podcasts, you can go on ibba.org/insights and listen to these podcasts. We have a whole archive from years ago. So while we're talking about this, if anyone listens to this in the future, they'll be able to look back and understand what kind of timeframes we're talking about. Steve, sometimes change is good, sometimes it's not good. So I just want to hear your opinion. Are these SBA rule changes, they going to help or harm our industry, in your opinion?
There's two sides to that coin, absolutely. And when these rules first came out on June 1st of 2025, everyone took offense to them and said, oh, they're all bad. They're not all bad. I didn't actually take that opinion from day one. There were some rules reverted back to pre-2023, And we'll get into more of that. But I think that some middle ground there is where it's going to wind up. But I'm not against them. And I do think, and I'm going to describe today ways we can work within the rules that are currently in place now. So I don't take them as all bad. I think that the last set of rule changes increased the defaults greatly. And maybe the SBA went a little too far to the other side. But I think they're going to find a middle ground and back up on some level. So great question. And I do think that overall, they're not bad. This is still the program, the premier program for our industry and your listeners, no question.
Steve, can you dig a little deeper into the 7A program, the $5 million cap, any increases to that, what that means particular or specifically for a buyer, down payment wise, structure wise, how something along those lines can be structured? Is it the same as other loans? Is it different? How is that looked at?
Well, good question. And really, what we're planning or what we're actually putting into place or trying to is just increasing it from 5 to 10 million with the same amount of down payment, 10% down. And I've had many lender conversations, and there's going to be more lender exposure. So there may be some hesitation on the lender side as well. But again, it's a big change. The aggressive lenders do embrace those larger transactions, and I do think it will be well received once it's out there. I am monitoring and want to see how the manufacturing loans go, as well as the SBA monitoring those. But I do think this is going to be all positive. As we've been saying for the last year and a half, 5 million buys over 40% less than it did when it was originally increased. And this is really to address where I think the biggest benefit is going to be those no man land loans between 5 and 10, 11, $12 million. That's really the group of people, sellers, buyers, and everybody that it's going to benefit. And that's where I think the huge plus is.
Great. It just opens the playing field up for a broader base of business that can be handled and potentially, like you said, that no man's land where it was very difficult to obtain financing, that now potentially it'll be there, and which will enhance the number of opportunities for buyers in the marketplace and for sellers being able to go to the marketplace and not have to do a larger seller's note than maybe they would want to, or some other kind of finance structure on their end, because there'll be other opportunity to be able to, for a borrower to borrow or utilize the SBA process to borrow more money.
Absolutely. And this is the conversation I've had with brokers across the country for the last 10 years. Yes, that's a great business. It is worth 8.5 or $9 million, but you're going to have to sit your seller down and say, you did a wonderful job. You just built your business to the wrong revenue level or sale price level. And there's just, like I said, there's no financing in there. And we've been getting creative for years over those transactions, handling those 8 and 9. But having a seller that's 72 years old holding a $2 or $3 million seller's note to bridge that gap, I always thought was inappropriate. It's almost penalizing the guy for building his business to an acceptable level where my buyers want that.
Yeah.
So
Great job. You're too large. You'd be better off if your business was a little smaller because
how sad is
you can cash out, right?
That's right. I actually feel better, but that's the conversation. You have to tell your seller he built it to the wrong size. That's ultimately it. But so I am very excited for all those people. We all know about the baby boomers and the businesses that are going to be coming to the market in the next year or two. And that's where a lot of these are. So this is a great program that we have to have happen.
We'll get into some more acquisition updates later, but I do have one more general update that I'd like you to talk to us about. And it's the SBA franchise registry returning. How does that affect the brokerage community?
Well, it makes lending a lot easier for it. And here's what the onus was before that registry came back out. The actual lender had to then review the FDD, the franchise disclosure document for a franchise, and make their own determination whether they were eligible or not. What that does is it opens the door for an ineligible franchise because they missed a word or a line in their FDD. And it opens the door for SBA to then void their guarantee on that loan. And putting that responsibility on the lender is just a huge undertaking. So when a lender can just go to the franchise registry and see that they're listed on there, that instantly takes away that whole piece for them. And they know now it's eligible and that they're not going to have an issue with the FDD moving forward. So I think it's a great thing. I've been pushing to get that back online for a long time. I don't want to see the lenders tortured over that. They shouldn't be spending hours trying to understand the FDD on one specific franchise loan. They should have a database. So I applaud the return of the franchise registry. And every broker should know that any franchise that they're looking at or considering listing, go check the franchise registry, make sure they're on it.
Yeah, I'd take this step further. I don't think it should have ever went away.
I agree with you. Absolutely.
People discount franchises too much. They think when people think franchises, they think, oh, someone's going to buy a franchise and start it up. But there are so many more resales of franchises in every industry that require potentially SBA loans. And when we're looking at it, it's so good to be able to have an understanding, both from a startup of a new franchise to a sale, a resale of a franchise, where that franchise stands within the SBA community.
You hit the nail on the head. I mean, we have two or three that are bigger transactions. They're well over $1 million, but they are in the franchise world. So we had to verify this right up front. But right, the transactions on acquisitions are up there on the franchises. So this is an important piece, and I appreciate you bringing that up.
No, great. SBA, people think the SBA, I'm going to borrow money from the SBA. And I always like to go back and to give a foundation to a business owner that's out there listening or a buyer that's out there listening. So Steve, I'm gonna ask you a question that I know the answer to, but I'm gonna ask the question. Does the SBA loan money?
No, the SBA hasn't loaned money in years and years. All they are, and this is how I describe it to my clientele, they are an insurance company that we pay a fee to insure a portion of your loan. And that's how they should be looked. So basically, the SBA criteria is, does it comply and is it eligible? And that's not on a cash flow basis or anything else. All it is an eligibility concern on the SBA side. That's why the franchise registry is such a great help. That just takes that piece off the table and says this is eligible. So yeah, I think I absolutely agree with you that this is important and a great piece to our industry.
So that people understand the importance of the SBA program. You have people that are out there that feel like, oh, yeah, I'll just go to my bank. I'll get a loan. Well, as long as the SBA program exists, I mean, how likely is it that a bank is just going to say, well, let's forego the SBA program and we're just going to lend you the money? I mean, there are some real guarantees and protections for the bank to want to utilize the SBA program. And to jump on top of that also, Steve, if there wasn't an SBA program, how many business transactions would really get done? And how would that actually look? Because I don't think it would look very good.
Well, you just talked about the benefits of SBA. Here's really what it is behind the scenes when it comes to the lenders. No one wants to put $3 million of goodwill on their balance sheet. It devalues a bank. And if you think about it from a logistics perspective, you walk into a bank, there are two questions you ask if you're considering buying that bank. A, how much money do you have lent out on the street? And B, how much collateral do you have securing it? The wider that gap, the less that bank is worth. So that's why the majority of the true SBA lenders, they don't put them on their balance sheet. They're selling them on the secondary market because they have a huge value. And that's where it generates cash flow for a bank and a lender.
And why a business transaction or a business loan is the riskiest loan out there. Because again, not everything is manufacturing where you have assets to fully collateralize the value of the loan. The majority or a good portion of the SBA loans, it's based on cash flow lending, right? A lot of businesses aren't going service businesses. They're certainly not going to have, it might be worth $1.5 million. They may have $100,000 worth of assets. So how a traditional banker looks at it and goes, oh, no, that's not a good loan for us. But because there is a program like the SBA, it makes cash flow lending possible.
Absolutely. And that's really what it comes down to. There's not a lot of collateral, which is the bank's foundation. And but when you're talking about cash flow that's been there for years, the risk is greatly reduced. The majority of our clientele are 1.5 million, 2 million plus transactions. And like you just said, with very little assets. We specialize in doing the majority of service contracting businesses throughout the country as far as fire water restoration, in-home healthcare. A lot of those larger industries don't have any assets and they're just staffing. Staffing is another industry. Very few assets, but they're very profitable businesses. And as I've seen them, $5, $6, $7 million staffing companies that
their assets are their people. you can't sell people.
Right. That's right. And the 5 computers they have at desk, they've depreciated down to $5,000. So, I mean, there's very little to grab onto collateral wise, but that's a perfect scenario. That when a client asks me what type of industry to buy, that's exactly where I send them. I don't care about $1 million worth of real estate. That's irrelevant to me unless it's generating cash flow. That's not my world.
Well, you want to know, can they pay the loan back? And do they hit the ratios that needed to be hit? I think that ties perfectly into the next area that I want to go to. I want to delve a little deeper into the equity rule change, how that's going to affect buyers that cannot provide the full SBA required 10% down payment. Can you talk to us about that?
Absolutely. And this is one of the hot topics we're working on with the senator as well. And again, it's not a rule I'm totally against. There are other people that are in the organization that are against this. But so what the new rule and what the rule changed, I'll describe before June 1st. Before June 1st, the seller could hold up to 10%, which is the entire down payment. And the buyer could come in with no money. Well, I don't support that. I never have. If they are a strong candidate, I do support 5% from the buyer and 5% from the seller. What they changed on June 1st was that seller 5% can now must be on full standby for the life of the loan. So prior to June 1st, it had to be on standby for 2 years. And then he could start collecting payments of principal and interest. And now it's on standby for 10 years and he cannot. Interest can accrue, it cannot be paid for the first 10 years of the loan. Now, there again, what we're talking about though is probably a very highly qualified buyer. It's going to be somebody internal, it's going to be someone with direct industry experience, it's going to be typically someone the seller supports. So if he supports it, and there are other ways to address this moving forward, well, one of the changes, and again, it's probably not something I'm supposed to talk about, is being able to reduce that seller's equity after 2 years. What I'm proposing is that the buyer can then replace the equity the seller provided in the beginning after 24 months. Now, that's not a rule, don't write that down, but it is something that I am going after. Now, here's the other rule that, again, I'm not against and I am in support of. What the SBA rule states is the 10% equity from day one cannot be reduced for the life of the loan. So that's one of the reasons why they're saying the seller can't be paid back because you'd be reducing the balance sheet equity. What I want to offer them is let's allow the buyer to replace that equity with his own post-tax dollars so that the balance sheet equity remains the same, and which complies with the other SBA rule that the equity cannot be reduced for the life of the loan. But what it does is, after 24 consecutive non-late payments, it allows him to substitute that equity position. So I think that's a happy medium, and I would love to see the SBA agree with me and put that into place. So what the rule says now is the seller cannot hold more than half of the down payment. Okay.
Okay. I want to say this to you, Steve. Look on your screen. It's just you and me. You could say whatever you want. Who's going to know? Let's just, it's okay. It's okay. So
where I get myself in trouble.
It's okay. Let's move on then. We talk about larger loans and the increase in caps, and that's great, but there are a lot of smaller businesses out there. And let's talk about the reduction in the small loan access from $500,000 back down to $350,000. Can you talk about that a little bit?
Yeah, and that's not really, I don't see a lot between that 350 and 500. We're either talking about $200-300 acquisition or $500,000-600,000 acquisition. I don't see that as a real, what that really means is that you have to process it in its regular avenues. So if it's a $450,000 loan, it's still going to get done. They just have to process it as they would any other larger loan. So I don't think it's a detriment. I do think that the 350 really matters for those startup franchises and for those smaller transactions. I think it's a wonderful thing to be able to crank it through the system like that. So going from 350 to 500, I don't see it as a huge detriment to the population or our broker industry.
Okay. There's one topic out there that has gotten the attention of business brokers, business intermediary, lower middle market advisors, M&A advisors, and they put the partial ownership eligibility, and that was such a boom for so many industries: home services, HVAC, plumbing, roofing, licensure required businesses. But based on the updated requirements, how is that going to affect businesses like that? or any business in general when it comes to partial ownership eligibility.
And you did hit the nail on the head. I agreed with you. As far as HVAC, plumbing, anything that had a license, what I was doing was I was leaving the sellers with 1% ownership. We had one scenario where we left him 4% ownership and he didn't want to stay. And what we did in their partnership agreement was the buyer promised to take him out once he got his license between that 12 and 24-month period when he was eligible to secure a license. But this is a hot topic, as you mentioned. So we're going to get into a little bit more in depth on this. Okay, so before the rule change, the partial ownership rule was no problem. If we left them under 20% ownership, they would just be an owner and they weren't signing anything, they weren't pledging any collateral. And this has actually changed since June 1st. When the rule first came out, what we did, because I'm on lender calls in the mornings with additional lenders, and we submitted to SBA and we said, well, if the seller, when it first came out June 1st, what the current rule says is the seller must guarantee the loan, even if he's a 1% owner. If he's retaining ownership, he must guarantee the loan for the first 2 years in full. All right. The first thing right after that rule came out, what the lenders did was they went to the SBA and said, if he's fully guaranteeing the loan, is his house going to be used as collateral? Are we going to look at his personal assets? And the initial response in the first week was, yes, he's a full guarantor on the loan. We have to look at the seller's personal collateral. Here's the good news on that. That has since been rescinded and officially written to say it's only his signature. Now, I'm still not happy with his signature for 2 years, and neither are most people, but I'm going to disclose how we're handling this to your listeners, okay? Because there are a few avenues we found to reduce the liability to the seller. So I'm going to describe that in two different scenarios. So the first one was there was a minority partner there that owned 8%. And everyone agreed that they wanted the minority partner to stay, even though the 92% owner was exiting. The 8% partner said, well, I'm not guaranteeing the loan, and I'm not going to put my family at risk for that 8% to guarantee the loan for the first 2 years. So what we actually did was the seller agreed. The first thing we did, let me back up a little bit. On this particular transaction, the first thing I did was try to understand the actual exposure that this 8% owner had. So what I did was I calculated 24 months of payments, and they came out to about $290,000. So I knew that this person's exposure maximum was $290,000 to get us through the first 2 years of ownership. Because after 2 years, their guarantee automatically falls off if there's no late payments. That's how it's structured today. After 24 months, the seller, if there's no late payments, the seller's guarantee automatically falls off. So what the 92% owner did for the transaction was they said, you know what, from the closing, I'll put $150,000 in escrow to ensure your second 12 months worth of payments. You're going to still be there. The buyer's going to make 8, 10, 12 payments no matter what. And the second year's worth of payments, I'm covering and putting them in escrow. And it made the transaction happen, that 8%. Now, what I've done since then is I've actually structured a different deal where there was only one seller and one buyer. And what they agreed to do was make double payments the first year and put the second payment into escrow. And this ensures, again, it reduces the actual seller's liability to only 12 months. But they were still going to be in the business because he was still a 10% owner. So they agreed, double up the payments, pay one to the lender, put one in escrow for the first 12 months out of the profits of the business. And it was still the buyer's funds. It just was, you can have it after we've made that 24th payment and my guarantee falls off. So by reducing the seller's equity, I think that's a valid workaround and makes it more palatable to make those transactions happen. Again, it's a portion of the loan that it has to be covered. I hate to see the seller guarantee the buyer's loan for 2 years.
Steve, this is why the industry benefits from people like yourself. It could be in banking. It could be on the legal side. It could be on the accounting side. It could be on the tax side. There are deal makers and there are deal breakers. And some people can't get deals done because they just don't know, or they're not willing to go the extra mile to figure out how we can get it done. and they're in banking and financing in the world of SBA. It's people like yourself that are saying, okay, we're not looking to break the rules. We have to follow them. But how can we, within the guidelines that are set forth, get a deal done? And that's to the benefit of all your clients, whether it be a seller brings a deal to you or a buyer comes to you and says, hey, I need something, or the intermediaries from around the country say, here you go. And so you and your colleagues and those in SBA that do that and really understand how to work within the system does this whole industry a service. So thank you.
Oh, you're welcome. And this is my job. What I did was I understood the rules. And that transaction with the 8% owner was actually the very first one where I said, there's got to be a solution here. Everyone needed her to, it was a her, needed her to stay. It had to, it was the right thing for all the parties. And like I said, the seller ultimately wanted this to happen. So I think it reduced her exposure and allowed her to then sign on the loan for the first 12 months. Really, that's what she's doing. But it made the deal happen. And that's bridging the gap. But when the buyer came to me and said, I'm frustrated because she doesn't want to guarantee the loan for 2 years. And there's got to be a way of fixing this. And sure enough, that was the solution. So yeah, it's thinking outside the box. And there are so many good SBA people throughout the country that really do that. And I applaud them as well. So I appreciate their creativeness.
It's important for the SBA lenders to understand that. But now the intermediaries that are out there listening, they understand it a little better based on what you've just shared. And a buyer who maybe feels like there wasn't hope, or there may be even a buyer and a seller listening to this right now that say, man, we went through that and we couldn't get the deal closed because that solution wasn't provided to us. So that's such great insight, and I appreciate that. Let's keep going. We talk about big numbers, so let's talk about, sometimes we poo little numbers. And it's funny because we could talk about 20, 30, 40, $50,000, oh, like it's nothing. But I promise you, if someone walked into our door today, Steve, with a check, said, hey, Steve, I want to give you extra 20 grand. You're not going to look at that. That's like that penny on the floor that nobody will bend down to pick up. You're going to be like, oh my God, thank you so much. Right. So $20,000. Why should the vehicle lien change amount increase to $20,000 matter to our industry?
Oh, this is huge. And everyone needs to take note of this. I can't tell you how many times here's what the rule said before June 1st. Anything that has a title, be it a truck, a trailer, a bus, an ambulance, anything that has a title must be held by the SBA lender if we are financing it. Here's where the problem comes in. True story. Okay, no matter what the vehicle is. Client calls me up 6 months later and says, we're going to junk the shop truck. All they used it for was lunch. He said, we're junking it, and I called the lender to get the title back because the junkyard won't accept it without a title. And they said, your asset value was $700. If you give us $700, we will give you back the title. To comply with the SBA rule that says we cannot reduce our equity or assets, you can replace assets. So my client, and this is a true story, he called me up and he said, you can tell the lender it will be parked behind the building for the rest of its life. So I said, okay, because he said, I'm not giving them $700 to junk the truck. But here's where it's critical and what matters. I looked at an ambulance company with 44 ambulances, and we knew every year he had to trade 5 or 6 in for upgrades. Well, that's where the problem comes in. An ambulance is not an inexpensive vehicle, and he was going to have to pony up $30,000, $40,000, $50,000 per ambulance. Now, what I've done with those is I cut that out and put it into a lease facility. And I said the SBA lender is not going to finance any of the ambulances. They're going to a leasing company. They're going to fund the ambulances to keep them away from a lender. But you got to keep in mind, anything with vehicles, window washing, bug control, anything that has any kind of fleet of trucks, this comes up constantly when they're going to replace vehicles because they can't just hand you back the title. This new rule now, that they understood this was a concern, okay? And to make it even worse, lenders were hiring third parties to go file the information with DMV because they had to make sure they perfected their lien on that title. I had one 6 weeks after the transaction closed, still hadn't gotten their registrations for their vehicles. And he was calling me up every week saying, my guys are out there driving these trucks with no registrations because the third party that the lender engaged was dragging their feet. And I had a workaround for that when that was an issue. But now what this new rule says is any vehicle that has a title that is worth 20,000 or less does not have to be held by the lender. So that's a huge thing. And whenever I see any type of business with a fleets or with this, anytime there's more than 5 titled vehicles, I went right to the depreciation schedule to see, well, how often do they need to change these? If these 5 vehicles will live for the next 10 years, then I'm okay. But if I know they're trading in 2 or 3 vehicles, I did a bus company, $190,000 value when we traded it in. Well, that's a big piece for the lender to lose. So we had to work all that out in the beginning because he had to trade a bus in every 2 years. So this $20,000 is a great change for all the pool service companies, anything that drives around. Like I said, what comes to mind is the bug control people, the whatever the case may be. If there are any vehicles that are valued under 20,000, they can now be left off the asset list for the lender, and that's a great thing.
All right, Steve, couple of more questions for you, and then
Okay,
we're
bring them
gonna
on.
get on with our day. But just some general questions. Should the 6-month look back rule be addressed before considering a buyer's offer?
I don't think so. I pay no attention to it unless someone's really going out of their way to create fraud or anything else. Typically, when I'm addressed that question, it's my buyer saying, what if I put my house in my son's name today? That's when this pops up. And I have to explain, no, we're going to have a 6-month look back rule, and that's not going to be eligible. So we don't condone bad behavior, and you can't do that.
So what is the 6-month look back rule? Just for someone out there that doesn't understand that.
Okay, on the buyer side, it's going to make sure you haven't transferred assets within 6 months of applying for an SBA loan. And that's what the rule says. You can't hide assets, you can't hide collateral, you can't do anything like that for avoidance of use as collateral for SBA. So we'll look at the tax return from last year. We'll also look at the sellers just to see that the ownership was the same and consistent, things like that. But I support the 6-month look back rule. People shouldn't be hiding collateral. We can address collateral on so many other levels. I'm a big fan of not offering up collateral, but there are correct ways of avoiding it and pledging it.
Okay.
One of the things I also teach all my clients is how to remove the lien on their collateral post-closing, because that can be done. And just for your listeners alone, here's what the rule says. The rule says you are allowed to exchange collateral for like collateral at any time, and the lender cannot stop you, which is my favorite quote. I'm all about providing the buyer the opportunity to do what he needs to do in the future without the lender's consent. So I encourage them to, what I do is I tell them their collateral position on the lender's perspective, which no buyer knows, by the way, because the equity in your home is different than collateral value taken by the lender. And no one recognizes that. So a house that has 25% equity in it actually has a 0 collateral position for an SBA lender.
Interesting.
Yeah.
And you're right. I would be willing to bet most people don't know that. They know it now.
Right.
But I bet they didn't know it.
I've suggested to them, listen, save up $100,000 CD, which you can make because I'm looking at your business in the first 6 months, and go back to the lender and say, I'd like to give you this CD in exchange for my house. And 9 times out of 9, they have to do it.
Great.
But yeah, that's another word. My higher net worth individuals that have houses, and this is a concern for them, that's how we address it. I teach them the methods of taking it off post-closing.
It's interesting. This wasn't a question I was going to ask, but now I'm going to. You have super high net worth individuals, but nowadays people have gotten really creative with their structures, with trust or irrevocable trust, or ways that if you looked on paper, they might not own anything, but clearly they have access to a lot. How is that looked at?
So here's the ultimate question. Who has control of the accounts? Right. If you and or your spouse, for your listeners, your spouse is the only one we can demand anything of and make sign anything. Okay? A spouse, husband and wife are looked at as one in SBA's eyes. So if you and or your spouse have complete control over any account, whether it be a 529, irrevocable trust, or whatever, if it requires only their signatures, it's available for us to take as collateral. Now, Chris, if mom or dad's on that trust and you're named in it, and you need an outside signature aside from your spouse, then it is protected and is off the table for us. So that is something you should also know.
Steve, when I got into this industry 26 years ago, my father taught me a very valuable lesson. He said, if you're talking to a husband, wife, spouse, whatever it is, he goes, and they're going to be looking to buy a business, maybe getting an SBA loan. He said, you better be talking to both of them, because sometimes husband doesn't tell the wife, doesn't tell the husband, or vice versa. They're not, one of them's very much for buying a business and signing their name on, and the other person is not. And it could cause problems. So now we have to look a little further beyond that. I like that. Who has access to the money or to the assets, correct?
Absolutely. And it's funny that you mentioned that, because back in the day, I was called by a wife post-transaction. And she accused me of putting liens on her three houses and then said, do I own anything else in this world? And my response was, yes, you own three UPS stores. But so I always encourage with every one of my clients, if your team members, whether it be your CPA, your spouse, or anybody else involved, I am happy to walk them through this as well, because I want everybody to be educated, and we make educated decisions together is always my approach. But I want them all in the loop as well. I've been down that road.
Smoother transition, for sure.
Yeah.
You and I share and have a mutual friend, really good friend of both of ours. Happens to be the executive producer of this podcast also, Jeff Snell. And I know the both of you are working real closely right now behind the scenes on behalf of not just the IBBA, but the industry as a whole, with some senators and working on these SBA rules and guidelines, and actually giving input. And they're listening and taking input from the people that matter, the people that are in the field every day doing these things. So I would ask you this last question. Do you feel that the current SBA administration is helping small business overall? And what actions have you seen taken?
Absolutely. I can tell you, I just posted something yesterday that shows they're working more towards small business. Kelly Loeffler, who's now the administrator, is pro small business, which is not the sentiment I got before. As we mentioned before, the $10 million increase, we started that probably a year and a half ago, Jeff and I was actually shut down up in DC and told not to bring this to their attention or address it to the low-level income communities as opposed to the higher level. So we didn't get very far, but I can tell you they are a lot more open now. Like, I'm happy and so proud that the IBBA is now having some input. Let's face it, we have 3,000 registered business brokers throughout the country. We needed to have a voice. I have been screaming about this for years with the SBA, saying there's a whole group of people that depend on this program that you're not listening to. So when they finally reach back out to us, this needs to continue. This needs to be the beginning of the communication between the IBBA and the SBA input moving forward. So I'm very proud to be part of that, and I'm thinking this is a great accomplishment.
Well, what they understand now, beyond the IBBA being the voice of the industry and 3,000 members, someone said, "Oh, that doesn't sound like a lot." Well, it's 3,000 members representing millions of business owners, not just across the United States. For this purpose, we're talking United States, but the scope goes beyond that. But for SBA purposes, so along the United States, millions of business owners that those members represent and it affects. And to the people out there listening, the politicians, those are voters. Yes, they are. They want to keep everybody happy, but these are good things in place. You have small business is the backbone of America. And without it, we would fail. We need those companies. We need to be able to provide the jobs to the people that are out there. And by encouraging and helping with small business sales and acquisitions, that helps keep the motor running. So, Steve, we're at the end of our time right now, but I would like you to, as always, just someone wants to contact you, they have information about your services, what you do, tell us how they can find you.
Sure. We can be found anytime at easysba.com. That's our website. On that homepage, you will also find a cheat sheet of the summary of the rule changes, which is a great thing for brokers. I encourage them to print that out. I hand them out all over the country. And you'll also find our petition, which we have about 1,200 signatures on already. And I am pushing that on both the NSBA level and through the senator. So we are making progress. We need more support. We need more voices. But this industry, our people are the ones who utilize the 7A program. I want to say more than anyone else in the world. So we're the people that they should be listening to. No question about it. And I'm happy that they're finally paying some attention to us. We got to keep this momentum going, and we got to stay on top of it. So if you haven't signed the petition, if you know somebody that hasn't signed it, get them to sign it. But the more power we can bring, the better. But we're in this to make a change, and it's all positive, I think, for the brokers.
All right. Well, I'll give you an amen, brother. So, that's thank you. Thank you for what you do. At this time, sometimes the guests log off. I want you to stay on with me as we say goodbye to our listeners. But first, I want to thank you, not just for today, but for always advocating for our industry and all that we stand for and all that we hope to do and gain, because this industry provides a livelihood for a lot of people and their families. And so thank you for always being accessible and coming on the show and being a great contributor and our go-to guy. And at this point, again, I can't thank you enough. So thank you so much, Steve.
Hey, I appreciate you, Chris. You've been doing this for a lot longer than I have. So I appreciate all your contributions as well.
No, so together now, you and I, we're gonna say goodbye to the audience. Thanks for listening to IBBA Insights. Again, thank you to guests like Steve Mariani that make this possible. And thank you for the listeners like you who make this possible. But if you're new to the show, you can go to ibba.org/insights. And there are years and years of great shows and topics that are timely and never get old, that'll help you. So you could listen to that. And then also you could subscribe on the site, and then you never have to miss another episode again. And you'll be notified when the most recent ones come out. So until the next time when we get together again on IBBA Insights, I'll look forward to talking with you at that time. And between now and then, I wish you guys all the best of luck, health, happiness, and success in all your endeavors. Have a wonderful day.